G'day, Trent Fleskens here from Strategic Property Group, and today I want to talk to you about the pros and cons of negative gearing. Quite regularly I find that when I'm having a chat with mates or clients about property, the factor of negative gearing comes into play. And with the government and opposition at odds about whether it should be axed altogether as an investment incentive in this country, I thought it would be poignant to tackle this one head on for everyone out there wondering just how it should be approached. And here's a great little example to explain it. Imagine a friend who came to you with a business plan to create a company solely for the purpose of holding it for 10 years and selling it to the highest bidder. However, in the meantime, you'd have to run at a loss every year, receiving around 20% of that loss back as compensation. And you're not even sure that you could sell that business for a huge profit in the future, or whether that profit will outweigh the losses you make over the next 10 years. That's what investing for negative gearing is. Sure, it's great for claiming back real and book value expenses against your personal income and getting a refund at tax time, but one, you only get it because your holding costs were higher than your rental income, and two, it can't be your sole strategy for investing in that property. It's called negative gearing for a reason. Generally, most properties that start off negatively geared will eventually turn into positively geared properties as a function of time as rent increases. When this happens, you start paying tax, not receiving a rent refund on it. But this is actually where we want to be. Not paying tax, but being in a position where we're actually making positive cash flow on our properties over and above expenses. It's about finding that balance in those properties that will deliver a solid return over time. So why do people have that general belief that negatively geared properties are better investments? Well, it's not that negatively geared properties are better investments, it's that better investments generally start off negatively geared because the value of those properties is generally much more than what a tenant could afford to match in rent at the time. On the flip side, positively geared properties aren't categorically bad investments. It's just that there is generally a reason a tenant would rather pay higher rents for a property that they could otherwise have purchased for a lesser mortgage payment. Either they can't or they don't want to live there based on market risk, demographic, or location. Examples of these are generally the cheaper suburbs and mining towns, which are at the mercy of transient populations with no incentive or ability to establish themselves permanently in an area. This can bring with it issues of high tenant turnover and higher risk of boom-bust valuations. There are property brokers out there that will factor the tax refunds of negatively geared properties into their sales pitch to you, and this is totally wrong. Negative gearing doesn't reduce your tax. It's not an offset or an income. It's a deduction against the money you are losing to hold an asset you hope will increase in value over time. Remember that. So next time you are looking for your next investment, try and flip the way you look at negative gearing on its head. Think of it as a safety net rather than a cash flow strategy. And ask yourself why a positively geared property hasn't already been purchased by the tenant. If you found this session helpful and are now wondering how to actually manufacture hundreds of thousands of dollars a year through property like me, hang around for the next session and tell me what you think in the comments below.